Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing Paymentus Holdings stock. As always, this is not individual investing advice, just how I analyze stocks. So this one came in by request originally a little while ago, and I've been kind of holding off making a video on it. One, because I own this one and I just recently bought it. And a few weeks ago, or maybe a month ago, I forget how long ago, it was a weekly pick over on Patreon. So I have weekly picks that are $25 a month over on Patreon. I also have a free tier over there, so go check that out. I post some videos over there that I don't post on the YouTube channel, even on the free tier. And then if you want weekly picks from me, like Paymentus was a while back, you can subscribe over there as well. So I wanted to delay kind of making a public video, even though I had a request for it, since it had just recently been a pick. And also, I also looked in, earnings were being reported relatively soon. So earnings came out today. They look to be pretty good. I don't know what the conference call is going to be like, but there wasn't any big surprises or anything on that front. So I was like, okay, now we can make a video. Also, when I reviewed the performance of the ideas that I've shared publicly on the YouTube channel at the end of the last quarter, I said that I wanted to try to share at least one buy idea every couple months, because sometimes I go a long time without having a buy idea, like a public one on the channel, especially when the market's at all-time highs, which it's near right now. It's kind of hard to find really good deals. Now with the weekly picks, I make myself do that. So I just try to find whatever the best thing I can is each week. And then for the full service that I have over there, it's just an ongoing process. Like, it's not necessarily, if there's nothing in a week, I don't buy anything. If there's 5 things in a week, like back in April, I'll buy 5 things. So there's a little bit of difference between all the kind of platforms and services that I'm on and that I offer. And sometimes it can be a little tricky managing them, but I just really try to make sure I'm being fair to everybody and giving everybody, what they deserve. So Paymentus, they reported earnings. They were good. This is a company that only has, we only have about 3.5 years of public data. So it would normally not fit into my typical, what I call my full cycle strategy, where I like to have a recession in there so we can see how cyclical the business might be and things like that, and just generally longer term data, earnings data. It does fall into my fast growth strategy. Now, I don't get into the details of the fast growth strategy on the public YouTube channel, but I do have a method that I'm going to show here that also works pretty well. It's just not as precise as the other strategy. And it uses earnings, but it doesn't require a long history. So that is kind of the difference between them. It's called the time until payback method, which I use for a lot of stocks on the channel because it's a pretty simple, easy valuation method that is easier for me to explain and easier for people to understand without getting into like a big, huge, long explanation of things. All right, so these guys do payment. They help customers make payments, usually to like utility style companies and things like that. So a lot of their business can come from like things that you need to pay for on like a monthly basis, rather than, like a PayPal or something like that. And I checked, and my local electric company uses them. I haven't used it yet, but I think I'm actually going to set up just an automatic payment system, because I'm still writing like checks like the old fashioned way to the electric company, which can be kind of a pain if you travel or do anything like that and you're out of town. Or just the mail has become a lot more inconsistent than it used to be, 15 years ago. Sometimes they just don't show up to my house to take my mail. Sometimes they do. And so just having an automatic system is probably worth a couple bucks or whatever that Paymentus charges in order to do that. So I'm looking into that. I might actually sign up on their program, but I was looking at it the other day. So let's look at the math here. We have a pretty small company, which is good. So they're only like $3.5 billion market cap. Now, this is important, I think, for a smaller, more niche, fast growth business, because the PE, if we just are going to look at that, let me see if I can, is like 50. Okay. So that's high. A company needs to grow pretty fast for a long time in order to justify paying that amount of money for it, like 50 times earnings. But as you can see, I mean, even after we had this giant 300% earnings growth a year, last year was like 60% earnings growth, which is good. This year's expected to slow down. They beat earnings by a penny, so this might go up a little bit, but so they might still grow like double-digit earnings this year. But you can see once they kind of slowed down, that's when we got this pullback in the stock price. So it's up a little bit after hours today, but we'll call it down like 30% off the top. And we had one of those drawdowns here back in April as well. So these are the sorts of buyable dips that you can find with growth stocks sometimes. So rather than paying a 75 PE, you can pay a 50, which is a big difference, right? Even though it's still pretty pricey. Now, you want to be able to hold growth stocks like this for a long time. So the reason it's worth looking at the market cap and thinking about kind of the total addressable market is because it's hard to grow really fast. Like usually I assume 20% growth a year maximum for in between 10 and 15 years. Because for a stock like this, I want to buy it and I want to hold it for at least 10 years. Preferably, unless it fails or something, right? So in my mind, I think, okay, I think they could grow into a $15 billion company in 10 years, which would give you like a 5x return, which is really good. That potential's there. Now, whether they do it or not is like another question, but you want to find these kind of usually smaller companies. Sometimes the bigger ones are good too in certain situations. I really try to find a balance of the two. But in the US, the Mag 7 are pretty expensive, although we did buy Google in April. So opportunities do come around, but it's hard for bigger businesses, despite what we've seen with like Meta recently and Nvidia and Microsoft, to grow at a really fast rate for a long period of time. Even Microsoft had a long period where they had relatively slow earnings growth until, the last 10 years or so. So that potential is there. And that's important because, one, you need the earnings to grow fast enough to justify the price that you're about to pay. And two, you are going to have a higher number of losers with a growth strategy like this, right? Just generally speaking, because they're less proven companies. Usually you're speculating a little bit more about how fast they can grow. Maybe they just don't grow as fast as you think. Maybe competition comes after other companies see that they're growing and making money. And all those things. And sometimes the growth is just temporary and then it falls off into cyclical. Because of the types of business they usually do business with, and they have a lot of recurring revenue, I think it will be less cyclical than a lot of other growth businesses. Like the cyclical risk seems lower to me with this company, which is one of the reasons why I like it. You think of like a small semiconductor company or anything involved in AI and especially like the build out of it, like electrical companies and things like that get like a big spike in the past couple of years from demand. That can just turn and go down quickly, depending on what the market does and how things are changing in more of a cyclical fashion. So you might think that they can grow 20% every year for the next 10 years, but really they're going to have years where earnings growth gets cut in half. And that doesn't get calculated in. And that's how people lose money on the cyclical side of some of those things, along with boom busts and things like that we've also had recently. So it can be easy to get sucked in to extrapolating out this huge, really fast earnings growth these guys have had, and other companies have done it too, where it just doesn't last. So I think that these guys have a good chance of having really good double-digit earnings growth going forward, without being super cyclical and have it completely fall off a cliff. So that helps the risk reward just in the big picture of things. Okay, so the way I'm going to do this after I've kind of set everything up there is I'm going to look forward 2 years to see what analysts think they can grow their earnings at. So we know this year's coming in a little soft. Right now I'm viewing that it's growing, but it's softer than 20%, which is what I'm going to assume they can grow earnings. I'm going to view that a little bit more as an opportunity. So because of this slow growth this year, we're getting to pay a 50 PE instead of a 75 PE. So that's the optimistic end of the, and with growth stocks, you kind of have to be a little more optimistic than I normally am, I guess. I normally always want to know, what the downside is, but I'm going to control that risk with position size. So this is just going to be a small, 0.5% of a portfolio position, because it is still going to be on the more expensive side. And it might even get cheaper even if nothing happens. Maybe just macro stuff happens and it gets cheaper and you can add a little bit more. So it's a small position. That's how I'm controlling that risk. So I'm going to be more optimistic looking forward here. And I'm going to assume that they grow 31% next year and then 39% the year after that, which is faster than the 20% maximum. That's my limit that I'm allowed to use. So I'm cheating a little bit in that way. But sometimes if I don't do that, well, I have a totally different method that I use, but that doesn't use earnings, that helps deal with this problem. But this is the other way to deal with it. You can look forward and say, okay, we're going to give you credit for this 2 years of really fast growth, and then we're going to assume you can grow at 20% a year after that. So what we're not going to do is assume you can grow at 30% a year forever, which the market can sometimes tend to do. So I'm going to look out and I'm going to say, hey, they earn $1 in 2027. How long would it take me to earn my investment back via just their earnings if they grow 20% in the years after that? Actually, I pull the first year forward, so slightly different than that. But you want to say, okay, I'm going to earn $1 a share in 2027, and that dollar a share is going to grow 20% a year. How long will it take me to earn my money back? So in order to do that, you need two things. You need the earnings yield, which is just the PE ratio inverted. And so this will be the forward, double forward, or going 2027 earnings yield. The earnings yield now would be 2 or something because it's a 50 PE. But if we look forward and they really do grow their earnings that much, you're going to get a 3.41% earnings yield to start out with. And then I'm going to assume they earn $1 and then that grows at 20%. So the way to think about this is, if you paid $100 for the company, you would earn $3.41 the first year, plus 20% growth, and I'm pulling forward. And that $3.41 would grow 20% each year. How long? And you just kept each year's money. So you keep the $3.41, the next year you keep the $3, whatever. I'll look at it in a second. How long would it take for that to add up to the $100 you initially paid for the business, right? So that's what this is set up for now. And you want to know how long how many years it would take to earn your money back. So yeah, if we get that first year of 20% growth, the first year would actually earn $4.09. Next year, $4.91. Next year, $5.89. Next year, $7.07. So you can see that it's growing pretty fast. But you're starting at a relatively low amount. And you're also looking forward 2 years, which I adjust for at the end. So when we look at how many years it would take to earn your money back with those assumptions, it would take about 10 years. That's pretty good. Usually a little under 10 or right around 10 is what I aim for. But we need to add 2 years to that because remember we looked forward 2 years. So you really need to earn your money back in 8 years in order to get to that 10-year mark, because we're looking forward at 2 years earnings growth. So this is going to be a 12-year time until payback. If they can hit their marks the next 2 years and then grow earnings 20% after that. That's the most I'm willing to pay for a growth business. If it's not a faster growth business, then usually 10 years or a little under 10, like 9 years is kind of what I aim for on an earnings-based analysis. So, but one of the and the reason for the difference is a lot of times, I shouldn't say a lot of times, sometimes with the really good companies, they will have a couple years where they blow earnings expectations away. So, and I'm not saying this will happen, but it has happened to stocks that I've bought, and it does happen sometimes. And if it happens early enough in the process, it can really affect the how fast you could earn your money back. So let's say, for example, instead of 30% growth, and let's call it 31 and 39, it's more than that. Let's say it's, I don't know, let's just say instead of earning $1 in earnings in 2027, you earn, I don't know, like $1.30. So we can see how that affects, that would be like they surprise to the upside. Okay, now you're down to 9 already, right? So, and if they earned $1.40 instead of $1, it's about the same, maybe $1.50. There we go. So if they surprise to the upside and they hit $1.50 over the next couple of years, then we're down to where we really want to be, which is more that like 10-year time until payback. So that can happen too. I don't like to count on it, but if I'm going to nibble at a long-term position, and with a business like this is one that I'm going to buy. I'm going to hold it, and I'm really not going to do anything. I'm just going to hold it for 5 years and kind of see what happens. Now, because it's my job, I check in on them, and if they really did poorly over the next 3 years, it's possible they could be replaced with a different company. But for the most part, they don't require a whole lot of work ongoing work, because once you have them in your portfolio, they're either going to work out or they're not going to work out over the long term. The ones that fail they don't always fail badly. Sometimes they can muddle around, but usually if you're paying a 50 PE and it doesn't work out, you're down 60 to 80%, usually something 50 to 80, something like that, at a couple years in the future, 2 or 3 years. So you have to accept that some of these are going to have bigger losses, but the reward is the ones that work will be from this valuation here, probably like a 5x over 10 years. So they'll be really big winners, and they'll be really big winners that you don't have to sell, unlike the cyclicals that I talk about a lot and that I specialize in covering. Those, you want to sell them when they get to the top of a cycle or to a certain point in the cycle, because they can fall 80%. If you get a good smaller growth business that doesn't really have that can kind of break through, especially early on with some surprise earnings growth, you can hold it for 20 years and not do anything and just make money. And so those are really the ideal stocks to have. And if you can get a couple of those a year, it really doesn't matter. I mean, you don't want too many losers, but you could have, if you got one really big winner out of 5, 2 that are just okay, like they're nothing to write home about, and then 2 that go completely bankrupt, you're going to be doing actually really well over the long term. So it's a little hard to wrap your mind around, because it's so hard to imagine these 500%, 600%, 700% returns over the longer term. But that's what you usually get on the bigger winners with strategies like this. And you just have to now you don't want to put too much money in them, because you don't know which ones are going to fail ahead of time. If I knew that, I wouldn't buy them, right? But I think this one has a pretty good chance of not getting complete. Well, you never know what's going to happen. It can happen to anyone. It can go badly. But I feel like it's a little less risky on the downside, like I mentioned earlier. And the upside is probably pretty decent, even in just an okay environment. So I think we could definitely have just an okay or sideways market economic environment, or choppy. And this is kind of a type of company that might be able to do just fine during that, when everything else is struggling, when a lot of other things are struggling, especially on the growth end. the people have really been paying too much for. I'm not going to mention any names, but these are like the sneaky little one type of companies that investors who know what they're doing can do well with, and the ones that are kind of looking at the shiny objects or just index investing are going to miss. And hopefully you want something like this to grow big enough where, well, in a perfect world, I don't know if this is the type of company that could get big enough to get in the S&P 500 at this point, but potentially it could. If it 10x'd and got to 30 billion, it could get put into the S&P 500, and then those are the huge winners, right? I'm not sure that, but you never know. I mean, over the long term, it's hard to say. Over 10 years, things happen. Sometimes competitors come along you don't expect about, but sometimes new services come along that you don't expect. That's what's happened to most of the Mag 7 or whatever. New businesses came along that were not foreseeable. I mean, first we had cloud, and then we have AI and social media. I mean, 20 years ago, hardly any of that was expected to be like what it is now. But they were able to add those on to their existing businesses. So when those happen, you can make a lot of money too. All right. Hopefully you guys found this useful. Again, small position sizes, buy and hold. That is what this is. Thanks for the request for this one. Sorry, I delayed it a little bit. Sometimes that happens. But I did want to make sure. I thought this was a good candidate as a buy for the channel. And I could also fulfill that request for the person that asked it. Thanks for watching. If you found this useful, hit the like and subscribe button. I'll see everybody later.